Welcome to the Financial Evangelist Podcast, your source for the latest in economics, crypto, and everything in between. From market movements to blockchain breakthroughs, we cut through the noise and bring you the facts fast.
Hey everyone, and welcome to the Financial Evangelist Podcast. I'm so glad you're here with me today. You know, it's crazy out there right now. The financial world feels like it's spinning out of control with all these headlines and market swings. It's enough to make anyone want to just, bury their head in the sand and ignore it all. But that's exactly why I created this podcast, to help you cut through all that noise and really understand what's going on so you can make smart decisions about your money without all the stress. And one of the biggest questions I keep hearing over and over again is, are we headed for a recession? Like, is it really going to happen, or are things just kind of, bumpy right now? So today we're going to tackle that question head on. We're diving deep into some insights from some of the sharpest minds in finance to try and figure out what's really going on and what it means for you. All right, so first things first. Let's take a look at what's happening right now. The markets have been a bit of a roller coaster lately. The NASDAQ Q especially, it's been taking a beating. And bond yields, forget about it. They're dropping like a rock. There's definitely this feeling of unease, not just here, but globally too. You even hear some analysts throwing around terms like market meltdown. Investors are flocking to those safe havens like gold and government bonds. They're looking for something that will hold its value if things really do go south. Now, one group that's been waving some pretty big red flags is Eurodollar University. They're making the case that the global economy has basically forgotten how to grow. They say we're on a one-way track back to recessionville. And what's really interesting is they're not just focused on the usual suspects, like the unemployment rate. They're digging deeper. They're looking at things like income growth, how many full-time jobs there are compared to part-time jobs, and even the average number of hours people are working each week. Why? Well, they believe these things give you a much more accurate picture of how healthy the labor market really is. For instance, the unemployment rate might look okay on the surface, but what if a lot of people are only finding part-time gigs or they're working way fewer hours than they used to? That's a sign that the economy might not be as strong as it seems right.
So Eurodollar University, they really dug into that February jobs report. And they found some pretty alarming details that a lot of people probably missed. Like, did you know that there was a big drop in full-time jobs? And the average work week, it's getting shorter too. Plus, there's been this surge in what they call underemployment, which basically means people are stuck in jobs that don't really use their skills, or they're working part-time when they really need full-time hours. It's like these little cracks under the surface that could point to some bigger problems down the road. Now, on the other hand, you've got the Federal Reserve, and they're painting a slightly rosier picture. Jerome Powell, the Fed chair, he recently said that the economy is in a good place. So it seems like they're not as worried about those warning signs that Eurodollar University is pointing out. So who's right? Well, that's the million-dollar question, isn't it? It's tough to say for sure, but it's definitely something we need to keep a close eye on. Okay, let's shift gears for a minute and see what the folks over at Rebel Capitalist have to say. These guys are all about understanding how narratives shape the market. And they've noticed a pretty big shift lately. They're saying that bad news is now bad news. Remember back in the day when bad economic news was almost like a good thing, because it meant the Fed might swoop in with more stimulus? Well, it looks like that dynamic might be changing. And one of the key signals they're watching is the 2-year Treasury yield. Now, I know that might sound a little technical, but bear with me because this actually matters a lot for your own personal finances. Basically, when this yield drops sharply, it's a sign that the market thinks the Fed is going to cut interest rates soon, which is kind of interesting because the Fed has been hinting that they're going to hold steady or even raise rates. So there's this disconnect, between what the market expects and what the Fed is saying. So what does this all mean for you and me? Well, if interest rates do go down, it could make things like mortgages and other loans cheaper, which sounds pretty good, right? But it also means you might earn less interest on your savings accounts. And here's where it gets really interesting. For anyone who's thinking about buying or selling a house, lower interest rates can have a big impact on the housing market. We might even see home prices start to cool off, which could be great for buyers, but not so much for sellers. But wait, it gets even wilder. There's actually this theory going around that the current administration might be trying to create a short-term recession on purpose, almost like hitting the reset button on the whole economy. The idea is to clear out all the risky investments that have been piling up, they call it malinvestment, and try to set the stage for a healthier economy in the long run. It's kind of like a financial detox, It might be rough in the short term, but maybe it leads to more stability down the road. Of course, this is just a theory, but it's definitely an interesting one. And it makes you wonder what it would actually mean for the average person. Now, let's bring in another perspective.
Stephen Van Meter has been ringing the alarm bells about government job cuts. He says that when you combine these cuts with a private sector that's already slowing down, it's a recipe for a recession.
He's saying, look back at past recessions. A lot of times you see this wave of job losses right before things really tank. It's like a warning sign. So it's definitely something to watch, especially with all the other economic red flags we're seeing. And speaking of those warning signs, let's dig a little deeper into some of that data Eurodollar University was talking about. They mentioned that big drop in full-time jobs. And it's pretty eye-opening. Full-time jobs, they're the foundation of the economy, right? That's how people pay their bills and buy homes and save for the future. When those jobs start disappearing, it creates this ripple effect. It hits consumer spending. It hits business investment. And it's not just about how many jobs there are. It's about the quality of those jobs, too. Remember that decline in average weekly hours worked? That tells you that even people who have jobs, they're facing uncertainty. Maybe they're getting their hours cut back, or they're worried about getting laid off. And that kind of instability, it weighs on people. It makes them think twice about spending money. And that just slows the economy down even more.
Then you've got that underemployment figure, which is really important because it captures all those folks who are working part-time but would rather have a full-time job. Or they're stuck in jobs that don't really use their skills and education. It paints a much bigger picture of what's going on in the job market than just the unemployment rate alone. So what does all this mean for you? If you're thinking about making a big purchase like a new car or a house, it might be a good time to take a step back. Really assess your financial situation. Make sure you've got a solid emergency fund and that you're not taking on more debt than you can handle. Because if a recession does hit, you want to be ready. Now let's go back to that idea that Rebel Capitalist brought up, that bad news is now bad news. It's a really interesting shift in how the market's thinking. And it's worth understanding why it's happening. For years, it seemed like the markets were hooked on easy money. Every time there was a little bit of trouble, the Fed would step in with more stimulus. Investors would be like, woo, party time, but that party might be over. I think investors started to realize that all that stimulus, it came with a price. It led to inflation. It inflated asset bubbles. And it created this sense of complacency. Like everything's going to be fine forever. But now with inflation still high, and the Fed raising interest rates to try and get things under control, the markets are getting nervous. They're not so sure that the Fed is going to come to the rescue every time there's a little bit of bad news. And that brings us back to that 2-year Treasury yield. Remember we talked about how when that yield drops sharply, it means the market thinks the Fed is going to cut interest rates. This could be a sign that investors are betting on a recession. And they think the Fed will have to reverse course and start cutting rates again to try and stimulate the economy. And this is important for you because it can affect everything from your mortgage rates to the returns you get on your savings. If the Fed does start cutting rates again, it could mean lower mortgage rates, but it could also mean lower returns on your savings accounts and investments. Now, let's talk about that really radical idea of an engineered recession, that detox for the economy. It sounds kind of crazy, right? But there are people who actually think that a short, sharp recession might be the best way to clear out all the excesses in the economy and set the stage for long-term growth. The thinking goes something like this. The economy right now, it's built on a lot of shaky foundations. Things like too much debt, risky investments, asset bubbles. And those imbalances, they can't last forever. Eventually, something has to give. So the idea behind an engineered recession is to kind of rip off the Band-Aid. Just let those unsustainable businesses and investments fail. Let the air out of those bubbles. And then once all the dust settles, the economy can start to rebuild on a stronger foundation. It's like hitting the reset button. Of course, this is a really controversial idea, and it would definitely be painful in the short term. A lot of people would lose their jobs, businesses would close, stock market would probably take a big hit. But the people who support this idea, they argue that it's better to take the pain now than to let these problems get worse and potentially lead to an even bigger crisis down the road. It's a really interesting thought experiment. It makes you think about the trade-offs involved in trying to manage an economy. Do you try to keep things going indefinitely, even if it means just delaying the inevitable and maybe making things worse in the long run? Or do you take a more drastic approach and try to reset the whole system, even if it means a lot of pain in the short term? Now, remember what Stephen Van Meter said about those government job cuts? He thinks they could be a big trigger for a recession, especially if the private sector is already struggling. And he makes a good point. Government jobs, they're a big part of the economy. And when those jobs disappear, it has this ripple effect. Think about it. When government workers lose their jobs, they have less money to spend. That means less demand for goods and services. which leads to lower sales and profits for businesses. And when businesses start to struggle, they might have to lay off workers, which means even less consumer spending. And it just creates this vicious cycle. And it's not just about the numbers, either job losses, whether they're in the government or the private sector. They can really hurt people's lives. It can cause financial stress, anxiety, depression. And when people are struggling to make ends meet, it can lead to social unrest and instability. So what can we learn from all of this? Well, it shows how interconnected the economy really is. What happens in one part of the economy can affect the whole system. It also shows how important it is to have good economic policies. Policies that promote sustainable growth, create jobs, and protect people who are struggling. Okay, let's zoom out for a minute and look at the global economy. Remember we talked about China's declining inflation, the possibility of a housing market crash over there. These are big concerns, not just for China, but for the whole world. China is the world's second largest economy, and its growth has been a major driver of global prosperity for decades. Well, we've seen it happen before. When China has problems, the rest of the world feels it. And right now, China is looking a little shaky. Declining inflation. It might sound like a good thing, but it can actually be a sign that demand is weakening. And if demand in China starts to dry up, it could have a domino effect on the global economy. Remember, China is a huge importer of raw materials and goods from all over the world. If they start buying less, it could hurt businesses and economies everywhere. And then there's the possibility of a housing market crash in China. This is a big deal because China's housing market is enormous, and it's been a major engine of economic growth for years. But there are signs that the market is overheating, and some analysts think a crash is inevitable. If that happens, it could be devastating for the Chinese economy. It could also trigger a global financial crisis, similar to what happened in 2008 when the U.S. housing market collapsed. So what does all this mean for you? It's a reminder that we live in a really interconnected world. What happens on the other side of the planet can have a real impact on our lives and our finances. It also shows how important it is to diversify your investments. Don't put all your eggs in one basket. Make sure your investments are spread across different types of assets in different parts of the world. That way, if one market or region takes a hit, you won't lose everything. I know this is a lot to take in, but I really believe that knowledge is power. The more you understand about the economy and how it works, the better decisions you can make about your money and your future. And remember, even when things are uncertain, there are always opportunities out there. So are we really on the brink of a recession? Well, it's tough to say for sure. But, as we've been talking about, there are definitely some warning signs out there, both here in the U.S. and around the world. The markets are all over the place. Inflation is still hanging around. And a lot of experts seem to think a slowdown is coming. But here's the thing about recessions. They're not always a bad thing. Sometimes they can actually be a good thing in the long run. They can be a catalyst for change. Think of it like a forest fire. It might be destructive in the short term, but it clears out all that dead wood and makes way for new growth. Recessions. They often force businesses to become more efficient and innovative. They shake things up and create opportunities for new companies and new industries to emerge. Some of the biggest companies in the world today, like Microsoft, Disney, General Electric, they were all actually founded during recessions. So yeah, it's important to be aware of the risks and make sure you're protecting yourself financially. But don't freak out. Recessions don't last forever. And when things settle down, there will be new opportunities out there for people who are ready to grab them. Maybe you've always wanted to start your own business, but you've been putting it off. A recession could be the perfect time to take the leap. There might be less competition, and you might be able to find some amazing deals on things like office space or equipment. Or maybe you've been thinking about learning a new skill or going back to school. A recession could be a great time to invest in yourself and make yourself more valuable when the economy picks back up. And don't forget, recessions usually lead to lower interest rates, which could be a great opportunity if you're thinking about buying a house or investing in real estate. Of course, you got to be smart and make sure you're not getting in over your head financially. But if you're careful and strategic, a recession can create some really amazing buying opportunities. So the bottom line is this. Recessions, they can be tough, but they're not the end of the world. They can actually be a time for innovation opportunity and even personal growth. It's all about how you look at it. It's about recognizing the challenges, but also seeing the potential for positive change. And that's really what the Financial Evangelist podcast is all about, helping you understand the financial world so you can make smart decisions and build a better future for yourself, no matter what the economy is doing. So if you're feeling overwhelmed by all the negativity out there, just remember, you're not alone. We're all in this together. And by staying informed, being proactive, and looking for the opportunities, we can not only survive, but thrive.
Thanks for joining me for this deep dive into the world of finance. I hope you found it helpful and maybe even a little bit inspiring. And if you want to stay ahead of the game and be prepared for whatever comes next, make sure you subscribe to the Financial Evangelist podcast. I'll be back next week with another episode to help you navigate the crazy world of finance. Until then, stay informed, stay positive, and keep those financial fires burning.
Tired of spending countless hours sorting through your crypto transactions? Meet Coinly, your all-in-one crypto tax solution. Whether you're trading, staking, or mining, Coinly automatically imports and categorizes your transactions from over 700 exchanges and wallets. Generate accurate tax reports in minutes, track your portfolio performance, and stay compliant with your local tax authorities. Coinly supports tax regulations in more than 20 countries, making crypto tax season stress-free for investors worldwide. Join over 1 million users who trust Coinly with their crypto taxes. Visit the link in the description to get started today and receive 20% off your first tax report.